Hello, I'm Sarah Singer, Chapter Executive for ACG Austin, San Antonio. It's my pleasure to welcome you to the first joint event with ACG chapters from San Francisco, Silicon Valley, and Austin, San Antonio. Thank you for joining us as we discuss what's trending in tech today, from the Silicon Valley to the Silicon Hills. Okay. At this time, I'd like to recognize the companies who serve as sponsors for our various chapters. Thank you to these firms who are annual sponsors for our Austin San Antonio chapter. The San Francisco chapter is supported by these sponsors. And finally, these sponsors support the Silicon Valley chapter. Now I will turn the program over to our moderator, Sindhu Rajesh, audit partner at Weaver, to introduce herself and our panelists.
Hi, everyone, and welcome to our discussion on tech trends today. And big thanks to all the different chapters of ACG for hosting us. I'm Sindhu Rajesh, audit partner in Weaver's investment fund practice. Weaver is a national full-service CPA firm with over 750 employees across 13 offices from California to New York. And we provide audit, tax, and advisory services for both public as well as private companies across a range of industries, including a practice focusing on the tech sector. And today's session is just the first in a 4-part series that'll focus on current trends in the tech sector. And our discussion today is going to be a little bit more broad-based. So we're going to talk about the current technology industry landscape, specifically the economic and regulatory environment. We'll touch on a little bit of the rising tech stars, and also the effects of ESG and impact investing. And of course, everybody's favorite topic, the boom in SPACs and direct listings. So we'll touch on that as well. So with that, I'd like to turn it over to our panel. And so Alex, if you want to kick things off and make a brief introduction.
Thank you, Sindhu. I'm Alex Rubalcava, the founder of Stage Venture Partners. Based in Los Angeles, I invest in enterprise software startups at the very earliest stage, coming in as a seed investor, and I invest across all sorts of industries and technologies, everything from industrial and manufacturing and space to healthcare and life sciences to software tools for e-commerce startups. And I'm delighted to be here. Thank you.
Sinead?
Thanks, Sindhu. So I'm Sinead Colton Grant. I am the Deputy Chief Investment Officer of BNY Mellon Wealth Management, and we manage 120 billion in client assets. So the areas that I'm responsible for are active large cap equity, equity trading, and our capital markets group. And topically for today, I'm also leading the responsible investing efforts at the firm.
Thank you. Patrick?
I'm Patrick Ringsred, an executive director at CIBC, the large Toronto Stock Exchange listed Canadian bank. I work in our US M&A advisory practice, primarily focused on selling companies ranging in enterprise value from 20 million to 500 million. And I help lead our software practice there.
Thanks, Patrick. So just to kick things off, everybody knows that 2020 has been a huge year for tech, right? And 2021 seems to have continued that trend if you just ignore the public market performance of the last 2 weeks. And if you look at the administration, the new administration's policy, there seems to have garnered a lot of interest from the tech sector as well. And there's clearly a shift in both focus as well as policy direction that's been favorable to certain industries and not so much to others. It's created more challenges for others. So I'd love to hear from all of you on where do you see the Biden administration's policies having the biggest impact on the tech sector? Patrick, do you want to kick things off?
Yeah, great. So one area that's clearly of interest within the Biden administration is clean energy. There's a number of initiatives around funding and mandates and the like in that area. And I think what they're looking at is trying to help support a variety of initiatives across renewables, battery technology, and the like. And it's hard to ignore what success that China has had. And there's certainly concerns there with regards to leadership in defining technical standards and the like. But even beyond the technology, also just the accessibility to resources that are necessary to drive some of these initiatives, like battery technology and EV cars and the like. There'll be, I think, certain initiatives on making sure that the proper raw materials, et cetera, are accessible and available to US-based companies. And I expect that that will be a big initiative as well.
Yeah, and I'm glad that Patrick mentioned China as part of policy and risk going forward, because I think one of the biggest risks that the country faces and that must be dealt with in policy is the semiconductor dependence that the United States has on Taiwan and the strategic problems that that causes with China in that regard. Taiwan Semiconductor is at least 2 process nodes ahead of Intel. We have no modern semiconductor fabs in North America, and everything would grind to a halt if the supply chains out of Taiwan that are led by Taiwan Semi were ever interrupted. And it is fundamentally incompatible with the United States national security to be in that level of dependency. We are more dependent in a much more profound way on Taiwan than we have ever been on oil supplies out of the Middle East. And it's interesting to see that Senator Schumer is looking to push a pretty substantial looking bill to address some of those issues, and that could be the next major piece of legislation coming out of Washington.
I think both of my fellow panelists have made some very interesting points. Clearly, the administration has a focus on climate change, and that's going to be a tailwind for the renewable energy sector. That means, tighter pollution standards. Potentially, we're going to see a change in federal procurement. And of course, for all of the winners, there's obviously a loser. And we do see, obviously, fossil fuels and that sector being a significant loser. So within tech, what that means is the areas that enable or facilitate greener approaches will be in favor. So what does that look like? Carbon capture and storage, solar panels, wind turbines, batteries for electric vehicles. But I think the other piece that it's important to think about when you look at this holistically is the administration is really focused on how they can create new jobs that are going to replace those that are lost in those older fossil fuel oriented industries. So oil, natural gas, coal, the communities that depend on those, to the extent that some of these new technologies could also extend their reach there, we would anticipate that's going to see a significant boost. Now, a few dates to have on the horizon. We have the Global Leaders Summit in Washington on April 22nd. That's coinciding with Earth Day. And that summit has been organized by the Biden administration. So it's highly likely we will get some announcements coming out of that. The second is to watch the infrastructure package. So now that the stimulus package has been passed, the next focus of the administration will be on infrastructure. Many administrations have tried to do this. The Biden administration is going to try too. But to the extent that that moves forward, it will certainly have a much more environmentally oriented focus, given everything we're hearing from the administration so far. But I think the one piece that, while we are focused on tech, the other thing to think about is that generally the tech industry has not seen as much regulation as other industries, given the extent to which it permeates through the economy. And that's something we think is probably going to change. Hard to tell exactly where they'll focus at present, but areas like consumer privacy and how data is used seem like at least where they will start.
All right, thank you. So that's a nice segue into, you guys talked about clean tech and clean energy being one area of focus. We've also seen in the past year, there's been a big focus on health tech, biotech, fintech. Do you think these trends are sustainable, and where do you think the next growth potential is coming from?
Yeah, I'll start with that. I've done a reasonable amount of health tech investing over the last year. I've invested in a company to match patients to clinical trials using EHR records. I've invested in a company that helps with recalls of medical devices. But in 2021, one of the areas that I've been very focused on is in space tech. So we're all seeing the videos of Elon Musk blowing up rocket ships in Texas at the moment. And at some point, he's going to get that Starship working. And that is going to lower launch costs to get a kilogram of payload into low Earth orbit in such a profound way that it's going to truly massively open up the space industry to a degree it's never been before. We're talking about getting something to low Earth orbit for maybe $100 a kilogram, maybe less than that. And that's going to just mean a proliferation of launches, of satellites, of missions. So I have recently invested in mission management software to automate a lot of that process. I have invested in 2 different companies doing engineering collaboration for those kind of companies as well. And we've also seen a lot of the customers, the rocket launchers, the satellite companies and whatnot, get taken public through SPACs. And so the entire industry is now well funded, and selling picks and shovels to those kinds of customers is, I think, going to be a pretty attractive business going forward.
And circling back on the health tech side, a lot of initiatives, investment that I've seen in the past year with the unfolding of COVID is really around data exchange and interoperability. There were certain government initiatives that were starting companies down this path, but COVID, at least in the States, has exposed the pretty stark inability of health systems to exchange and run analytical and run analytics on their data in an aggregated fashion versus some countries that were able to report very effectively. And beyond just health systems being able to exchange information, we're also seeing a lot of effort around creating greater connectivity between health systems and life science companies to drive clinical trials. There's a big effort around real world evidence, but at an even higher level, just trying to shorten the drug development cycle through data exchange, and sort of prove out or ascertain commercialization and viability of drugs. I think the COVID environment will pour gas on a lot of tech initiatives there. There's also been a lot of investment in healthcare tech just around the fact that people can't physically interact with each other in a COVID environment. And certainly companies like Teladoc have ridden that telehealth, telemedicine adoption wave that was previously driven by efficiencies and acceptance by payers, et cetera. It'll be interesting to see in a post-COVID world, the sustainability of the growth in telehealth, but I suspect that it will continue to see growing adoption going forward.
Sinead, any thoughts on that?
Well, I think my co-panelists have covered it very effectively. I mean, look, when it comes to the investor perspective and when we're investing on behalf of our clients, really what we're looking for are developments that can gain critical mass. And the most significant development over the last year has been just the rapid adoption of technology, that digital acceleration that we really weren't expecting to see for perhaps another 5 years or so. And that has permeated through every part of the industry. So when we're looking at the long-term potential for individual companies, a large part of that is how they've been able to pivot, or whether, in fact, they've been able to pivot. Certainly a very interesting area.
And one of the things I know we talked about previously during our earlier discussions was the cryptocurrency and blockchain technology and how that's impacting the whole tech sector. Anyone wants to share thoughts on that?
Yeah, I can start on that. I'm probably the only software investor in California who's generally skeptical of crypto. It's been 10 or 11 years and $500 billion invested in the industry, and we can't really figure out what to use it for yet. Just in the last month, we've started using that for non-fungible tokens. One of the auction houses, I think Sotheby's or Christie's, did an auction today for $70 million for a piece of art. And to me, I look at non-fungible tokens and I say, okay, so we're going to burn a ton of coal to generate a cryptographic hash, and then we're going to staple a JPEG to it and call that art. And I'm a little skeptical of it. It reminds me of the Romans rounding up every lion in North Africa to put onto the floor of the Colosseum for entertainment, and call it progress.
So I think it's just reading an article. Sorry, go ahead, Sinead.
I think it's a very interesting area. I mean, look, when you think about Bitcoin, it's been around for 10 plus years. It makes you think about how you define money, right? Because if you follow the chain from the barter economy through the gold standard to the fiat currency that we have today, each of those evolutions came with resistance, right? And it takes time for those approaches to become mainstream. We published a paper recently on our thoughts in the area, because you are seeing increasing interest from institutional investors. Potentially, it's interesting as a store of value if it truly is separate from individual economies, and that potentially could be an inflation hedge. It also may provide diversification relative to equities. And given how low bond yields are at present, having an alternative safe haven asset could be very interesting. But the thing that really is required here is regulation. The regulation has not kept up. The realized volatility on an annualized basis for Bitcoin over the last 3 years is 85%. That is multiples of the volatility of what you see in other asset classes. So in order for it to really become viable in a portfolio context, the volatility has to decline and the regulation really needs to evolve to allow it to be used more broadly.
I was just reading an article today on Bitcoin and whether that is really climate proof or is it really anti-climate, right? And one of the bloggers was writing an article on that, and he said that Ether and some of the other denominations, they've actually gone to a proof of stake rather than a proof of work concept, which actually uses less electricity. So it's a little bit more greener that way. And so he thinks that as things evolve, it would become a little bit more energy efficient and less, onerous on the climate. So we'll have to see where that evolves. But definitely a lot of Wall Street firms have, given it ready acceptance, and that's definitely going to change the way other people perceive it. And Tesla has been investing in Bitcoin, and you've seen some of the other companies follow suit as well. So definitely going to be interesting times with that. The other topic I want to touch on while you're on that topic of energy is ESG, which stands for economic, environmental, social, and corporate governance. And it's become this huge buzzword right now, where many companies kind of want to be tagged as ESG compliant, be it for gaining market share, for getting bigger consumer footprint, for raising capital, going public. There's lots of different reasons they want to be seen as ESG compliant. But what does it really mean? And is there pros and cons of being ESG compliant versus not? What's like the impact? And is it possible to really be profitable while being ESG compliant? Sinead, I'd love to hear your thoughts on that.
Well, let's firstly address the term ESG. We don't actually use that term because we think that it can be quite polarizing for investors. It can be specifically associated with climate change. We tend to find that a more neutral term, such as responsible investing, resonates more across the board. But to address the first question, we don't believe that ESG or responsible investing means sacrificing returns. You've got multiple academic studies that show that strategies that integrate those approaches have returns that are comparable to, or in fact are higher than traditional approaches. And the market has grown tremendously. To put some figures around this and why it's on the radar of so many companies, the US Sustainable Investment Finance Report for 2020, which measured assets under management as at the end of 2019, showed sustainable assets of 17 billion, that's 17 billion, which is approximately a third of all of the assets that are professionally managed in the US. So this is certainly not a niche. It is a very important part of the financial ecosystem. So when we think about what investors are looking for when it comes to responsible or ESG oriented firms, it's multifaceted, and they want to see it integrated within the company and every aspect of the company. So, you know, you've got the environmental piece, the E of ESG. Certainly that's coming more into focus with the Biden administration. So there you're looking at ecological impacts, waste and wastewater, air quality, all of those types of metrics. When you get into the social aspect, that actually covers a multitude. So it's everything from consumer privacy, data security, human rights and community relations, to employee engagement and diversity and inclusion. And in terms of the overall picture of a company, there are certain elements that will be more relevant for some companies than others, but it is very holistic. And then the final piece is governance. So governance, it really means the leadership of the company, doing business ethically, how you deal with, how you approach the competitive landscape, even extending as far as critical incident risk management. So, I mean, these are what I've mentioned are a subset of the areas where these types of approaches come into play, but you can clearly see that it's holistic. And they're fundamental risks that form part of an investor's holistic view of a firm. So, you know, is it possible to turn a profit while still incorporating these elements? I would think yes, but and increasingly it's going to be required as in order to gain interest from investors. And let me give you just one example, a live example of this, which it's an analyst that I worked with a number of years ago who worked in the energy sector. And he went to an investor meeting in Florida, and this was back in the mid-2000s. And as part of that, they met with company management, but there was an event afterwards where they were able to meet with some of the employees. And so one of the things he particularly loved was being able to interact with the employees. And in the course of one of those conversations, one of the employees said to him, "Oh yes, I'm so glad I work at company X. My cousin works at company Y, and you would not believe the shortcuts they're taking around risk management of their infrastructure." So you probably won't be surprised to hear that at this point, the analyst said, "Really? Tell me more." He got more details. He then dug further when he got back to the office into the practices of company Y. And as a result of what he found, he never invested in the stock. So long story short, company Y was BP. And of course, we all remember the Deepwater Horizon incident back in the 2010, I believe. But that is a very live example of how those ESG considerations can have a material impact on an investment.
Yeah, I would just add, you know, we sell companies in our practice, and when we have clients that can resonate with the ESG theme, we certainly play it up. I would say by and large, it's really mostly the E that we're playing up in that context. But for buyers, there's thematic approaches to investing that's really becoming a much greater practice. And you know, this, again, circling back to some of this renewables, clean energy, that E concept is immensely valuable and sort of forward thinking. And we've had success playing that up to the buyer universe who are marketing companies for sale. I would also tell you, for the private equity funds that we talk to as buyers, we're seeing increasing adoption of ESG explicitly. And that's being driven by their limited partners, which are endowments and other institutional investors. So ESG, you know, in the market that we're in, you know, it's valuable for sellers of businesses if they can resonate with that thematic. But then also, we're just seeing increasing adoption, you know, be it mandated or opportunistic, of private equity funds pushing to adopt this as they go out and raise new funds and the like, and their LPs are requiring it or asking for it.
On the issue of governance, I'll just leave everybody with a question to ponder when it comes to cryptocurrencies and blockchain, which is, how does a regulator serve a subpoena or a Wells notice to a blockchain?
Really
Some
good
of the many
question.
things that they need to figure out and regulate.
Indeed.
They're not able to keep up with it, unfortunately. It's just technology moving at such a fast pace. So just switching gears, and let's talk about SPACs, right? Just in the last 2 years since 2019, we've seen such a huge growth in just the less traditional avenues of companies going public, either by a direct listing or SPACs. In fact, the SPAC boom just over the last 2 years has been unprecedented. And you know, given the fact that SPACs have been around for a decade and it just gained popularity in the last 2 years, it's changed people's perception of this, and a lot more people are, you know, considering SPAC deals. I was just reading an article today on VC fund managers. Actually, Alex, was something for you to think about. VC fund managers are now slowly considering whether they should be getting into the SPACs. You know, they're investing in companies that are the SPAC targets. So why not be the SPAC sponsor and get a piece of that plus the promote? So, you know, it's a win-win. And what are some of the ethical dilemmas? What are some of the conflicts of interest that arise with VC funds now considering SPACs? So definitely they stood out of it in the initial SPAC craze, but now some of the VCs are slowly considering that maybe it's time to get into this market. So I'd love to hear you guys' thoughts on it. And is this a bubble that we're seeing, or is this here to stay? What do you think?
Yeah, so you know, I view sort of the growth of SPACs, as you noted, they've been around for a long time. I think it's reflective of public market valuations, which, as we've seen with interest or the treasury rates rise recently, have really been powered up by low interest rates as a result of Fed activities during COVID. So with public market valuations increasing relative to private markets, they've proven very attractive exit point for companies to either obtain further capital or, you know, set them on a path to exit. You know, some of these companies that are utilizing the SPAC or getting SPAC'd are companies that are pre-revenue or pre-commercialization, other companies. So they're not going through, you know, the normal normal capital raising process. It's unclear when they go down this route if that was because they preferred the SPAC or if perhaps their private market alternatives weren't actually in existence. And when you start to think about some of the consequences of this, you may be having companies made available to public market investors that may, you know, may not have private funding sources available to them. And so there could be implications in sort of returns for public investors, as well as these companies that are going public with, you know, pre-commercialization objectives. They're subject to a significant amount of interest rate or discount rate risk. And so they may ultimately be successful, but the volatility that they may experience as they proceed on their journey may be a bit harmful to investors, if you will. I do think in general it's better, more options are always better, and so it's certainly viable that SPACs make a lot of sense in certain contexts. But as we've seen in a lot of financial instruments, too much can be too much. I do think too, we talk about options and talking about direct listings, and the viability or growth of that, I think, has been beneficial to companies that are able to use that means of going public. Obviously, you can't raise additional capital through that path, but the benefits allow for immediate liquidity to shareholders. You don't have this so-called IPO pop, which is effectively a wealth transfer from the investors in the company pre-IPO to public market investors. And then you have lower fees in this context versus the traditional IPO. Now, the direct listings will grow in part because of those benefits, but also because there is so much capital available in the private markets. We saw Roblox do a direct listing, I think it was yesterday. They were going to go down the original IPO path, paused on that, raised some additional private capital, and then proceeded on the direct list yesterday, which I think valuations were something like 40 billion, and I think probably they were valued single-digit billions when they were initially looking at the prior IPO. So there's obviously there are business dynamics and changes in the overall market, but that was a sort of a nice case study in the benefits to the selling shareholders or the owners of Roblox prior to going to the direct listing route.
Yeah, Sindhu, you asked a moment ago if I should consider SPACing some of my own portfolio companies. You're my auditor, and I would welcome you to think about how I can justify charging 2 layers of carry to my LPs on the same deals. I haven't quite figured out how I should go about doing that and feel good about myself there. Well,
we can definitely talk about it. In fact, I think there's like 5 of the top big VCs have started, considering that for that same reason, because they're like, it's still a big pop for your investors. And so instead of somebody else taking the promote, having a sharing arrangement with your LPs could be one route. So definitely we'll talk about it offline.
Maybe 2 layers of carry is going to become the standard in business now. And I'm just old fashioned for finding that a little questionable. But with regard to SPACs, as long as, the buyer and the seller aren't the same people, I actually think that SPACs are a pretty good idea. And, I think about it in a few different ways. Number one, back in the 90s, we would take companies public all the time at valuations under $100 million. You had the 4 horsemen of the internet back in those days: Montgomery Securities, Hambrecht & Quist, Robbie Stevens, and Alex Brown, that took public a lot of the companies that are now dominant companies like Netflix and Amazon. That all went away over the last 20 years, and SPACs are sort of a way to bring that kind of thing back. The second thing I would point out is that, for the last 20 years, we have taken public over 100 companies a year that are pre-revenue biotech and med device companies, and the public markets have been an accepted way to fund the growth of those emerging growth type of companies. And yet, for some reason, that door was closed to IT and software related businesses, and SPACs are essentially a reopening of that door. And with regard to that, the dominant trend in investing today is indexing. Most fund flows are going to passive indexed strategies. And the widows and orphans of the world over the last 20 years have not rushed to sell their Vanguard S&P 500 index funds to buy whatever IPO of a biotech company came out last week. And I think that, we'll see if SPACs are the same way that way, but I don't see a systemic risk to the capital markets, given that most of the money's going in the other direction to index funds anyways.
So look, it's a very interesting point, and if we look at some of the drivers behind those fund flows going towards index funds, a lot of it is cost. So, and the fact that it's been more difficult for active managers to outperform their benchmarks. Look, when it comes to SPACs, the devil is in the detail for sure, because each one needs to be analyzed if you are considering it as an investment. The other thing to bear in mind is the interest rate environment. So last year, when we saw that huge expanse in the number of SPACs, there were two factors that really propelled that. One was ultra low interest rates. The second, and you saw this in public markets all the time, that the dominance of growth over value. So investors were really paying up to get companies that had solid growth prospects. Value-oriented stocks did very poorly. And you saw this in large cap, mid cap, and small cap. It's also one of the reasons why international indices did worse, particularly international developed, because they tend to be more value-oriented. But when you look at what's happening this year, we've had concerns about inflation coming to the fore. That has led to yields backing up. The short rate is anchored, but interest rates have been going up out along the curve. And in addition to that, you're seeing that there's greater certainty about the economy emerging from the pandemic. Not only have we had the stimulus package that was agreed yesterday, but we also have the rollout of the vaccine. And so within markets, you're seeing something of a reversion to focus on value. Taking those things together, I would say it's not going to be as straightforward an environment for SPACs as it was last year.
I was just reading an article this morning about how in all of last year, there were a little over 200 SPACs, 200 companies that went IPO through a SPAC process. And this year, just in the 2.5 months we've been around, we're already approaching that number. So it looks like 2021, it's still been a major boom in that SPAC sector. So we'll have to see how it kind of keeps going from here. But just in terms of any final thoughts, I'd love to hear any final thoughts that you have on the tech sector in general that we haven't touched on today. Alex, anything you want to touch on?
Yeah, I guess the only thing I'll say is that, it feels like people have been saying the whole way up that we're in a bubble in tech, and it feels to me like the opposite has probably been true, which is that we have underfunded and undercapitalized technological innovation over the last 10 years because we keep pushing into new ways of funding it, keep putting new capital to work, and we keep finding really good things and valuable things to do. And we might be fundamentally undersupplying capital to innovation in our country right now and in the world.
Sinead, any thoughts?
Well, as we move into the post-pandemic environment, I think there's really going to be a focus on where is the country dependent on external providers. That will mean a focus on supply chain, it will mean a focus on innovation. And I think that the next 4 to 5 years is where you could start to see a significant shift where risks are identified. Some of those will be viewed as national security risks now through a different lens, having gone through the pandemic. But I think you will see that proliferate across a number of industries, including technology.
Yeah, it's circling back a little bit to what Alex had said. I think one of the things that COVID and some of the numbers that are being put up by some of the public companies in technology, I think there has been an underestimated sense of the addressable market for these companies. And I think of like a company like DocuSign, for instance, which could have been, it probably has been perceived for a long time as a niche software tool, but the market that they're growing in, it continues to astound people. And I think you see growth rates in some of these companies that just in the public cloud companies, the dollar amounts and still holding growth rates that are just extraordinary. I think it's been vastly underestimated what the, we call it total addressable market for technology is. And I do think part of that is a thought process wedded to perhaps other industries that tend to be more zero sum, like the airline industry, for instance, where competitors, beat each other up. In technology, you have opportunities to sort of build on each other. And I think of a company like Twilio, for instance, that's developing developer tools. Their business is helping other businesses grow. This is another example would be Stripe. These companies are growing alongside their customers, and their customers are growing faster and bigger than anybody could expect. And as a result, these companies that are supporting them are. And so I don't think, I think the future is very positive for this market, and people shouldn't underestimate what the potential is out there.
That is a great takeaway. And with that, thank you all three of you, Alex, Patrick, and Sinead, for being on the panel today. Really appreciate your time. And we'd love to open it up for audience questions. If anybody wants to post or just ask direct, feel free to switch on your mic and your camera and feel free to ask the question.
I'll try one. This is Craig Jones. I'm a private equity investor at the low end of the mid-market, sort of micro LBOs. In our portfolio, we've seen a sort of a tale of two cities. So our healthcare companies are hurt by COVID-19, largely due to the fact that there's just fewer patients seeing doctors for non-emergency, non-necessitated medical procedures. They're all cash flow positive companies. We believe they're going to, bounce back very nicely in the second half of this year due to, demand, pent-up demand. On the other hand, our technology companies, as you said, have accelerated greatly. I wonder if the opposite could happen going forward. So could the, quote unquote ending of COVID-19, whenever that happens gradually, whatever, could that have the opposite effect where the companies that have been hurt by COVID-19 start to look more relatively positive? You're already seeing in the public market, the big techs coming down. Buffett sold Apple and bought Chevron, that kind of thing. So that's my question to the panel. Any thoughts that the investor appetite for technology companies might begin to decline as we enter into a more new normal, if you would?
I'll take a quick shot at that, Craig. Most of the businesses that rely on in-person work that have been negatively affected by COVID are capacity utilization businesses. So you're either seeing a full complement of patients in a healthcare setting or you're not. You're either seating, 2 tables an evening at a restaurant or you're not. You're either filling a hotel room or you're not. And now that the world is opening back up after COVID, one of the things that we're going to, I think, find is that a lot of capacity has been taken out of the industry by business closures due to COVID, and that most of the services economy is going to be undersupplied for the next year or two until new business formation and expansion of surviving businesses can react to that. So I actually think you're going to see just off the charts, completely unprecedented historical capacity utilization in the surviving businesses that are left. I mean, if you have a restaurant that has made it for the next year, you're probably going to have the best year of profits you've ever had in the next 12 months until the basis of competition stabilizes.
I would just suggest on the tech side, to the extent COVID has accelerated secular trends, I don't think, this is really just kind of, we can talk about valuations and those can be driven by a number of factors, but as far as like adoption and growth, I don't see there being all that much of a headwind there, just because a lot of these trends that occurred were sort of in process or in play before, and maybe we're earlier innings, and maybe we've skipped some innings, to use a bad baseball metaphor. But I think you'll see the growth. There's obviously, again, growth continued. There's obviously a lot of factors in valuation when you're considering selling.
We invest across the spectrum, and so we're looking across all of the large cap sectors. So I can give you some context on what we're doing in portfolios. We do still like technology, but we're pivoting to more cyclical sectors, so like semiconductors, which we think will be a big beneficiary. Your point on healthcare is well taken. Our expectation is that there will be parts of healthcare that benefit with the vaccine rollout. There will be other parts that really are going to need a significant cohort of vaccinations to have taken place before they pick up. But look, this is mirroring what we're seeing in the market. The market will pay up for growth when growth is scarce, and that was really what you saw happening in Q2, Q3 of last year. But it's not, in our view, a permanent state of affairs. Investors recalibrate, and they particularly recalibrate when there's a rising tide, when growth is going to boost the entire economy. And if you look at some of the forecasts for US GDP growth in the second half, it's in the region of 10%. That's enormous. And so I think the area of caution is when there is that rising tide, investors tend to become more discerning and they don't pay as much for growth.
Thank you. We have another question that's come up from Phil. The question is, what do you see as the most likely headwinds in the next year or two that could negatively impact the investment of capital in tech or other industries? Or do you see any shift in the trends going back towards more investment in private ventures? If anybody wants to take a crack at that?
I guess, so we've been on this sort of continuous decline in interest. I mean, it's continuous is an exaggeration, but a decline in interest rates, which when applied to growing companies, just discounting back their cash flows, it's been a massive tailwind for equities and the like. And I think, in the public market side, probably the biggest surprise, if there is one, would be, a surprise interest rate change. The government, with the borrowing that's gone on in COVID and some of the treasury auction noise and the like, you could have spikes potentially, and that rattles investor confidence. I think people are assuming, which I'm not saying, I'm not either, but, some sort of Japanese, low interest rate, stable environment, and that may not be the case. And so that rattling would impact the public markets, and to the extent, public market valuations come down again, that would keep people in private markets, for a longer period of time, or sort of reset this private public paradigm that's seemingly shifted in 1 year. That would set them back. And private investors, obviously, they don't have to necessarily truly mark to market, and they have, I would say, a longer term mindset than public markets. Some may disagree with me on that, but probably one of the benefits is they don't have to mark to market. So I think that's probably, in my mind, the biggest risk is interest rates, which then by extension would push people back into staying in private markets long.
Look, I would say undoubtedly the biggest risk is inflation. Relates to interest rates, but you've seen markets reacting to concerns that the Fed will get behind the curve and then have to raise rates a lot more sharply. But the big driver of all of that is inflation. And the big change that we've seen in this particular cycle was the Fed cut rates a lot, but they are now saying that their inflation target is symmetrical, which means that for the period that they were that inflation was below their target, they're now going to allow it to run a little bit above their target. And what markets get really concerned about is then their ability to rein it back. Now, our view is that any inflation that we see is likely to be transitory, but that piece is going to come within the next year, 18 months. You're already seeing supply chain bottlenecks. You see shipments taking longer, they're more expensive, there are bottlenecks at the ports. That is likely to lead to inflation. And you've also got the bottleneck in terms of just pent-up demand as people start being able to be more active in the economy. But when you look over the next 3 to 5 years, in terms of the potential risks, the big two, inflation for sure in terms of its impact on valuations, but the second I would say is the potential for regulation coming out of the Biden administration.
With regard to, what could be headwinds, I think, valuations are a big deal. If we look at, I happen to invest very actively in data warehouse companies. That's an area that I know quite well. And of course, Snowflake was one heck of an IPO last year, but Snowflake's trading at what, 50, 60, 70 times revenues? And, that's revenues, by the way. That's not earnings or free cash flow or EBITDA, that's revenues. And it reminds me of Scott McNealy, the former CEO of Sun 18 years ago, giving a speech about the valuation of his company when he hit 10 times revenues and then the stock fell 90%. And he said, we have cost of goods sold, which are pretty hard to avoid for a computer company. And we have to pay employees because they don't work for free. And we have to pay taxes because the government does want taxes from us and has the power to enforce that over us. And then, even if we didn't have any of those things, it would take you 10 years to get your money back at 10 times revenues. And now we have companies trading at 50 or 60 or 70 times revenues. And, I think that raises some interesting questions about what happens to a company like that when valuations come down. So you can, on the one hand, be very bullish on a sector and an area and a growth trend, but at the same time, if that's more than priced in, you do not have a variant view relative to the consensus view of the market.
And that brings up another point is I read about how Amazon and Tesla, when they compare, Amazon was trading at what, like 5 or 6 times multiple compared to like Tesla was at one point trading at like 90 times revenue multiples. So here's another question on Tesla. It says, can Tesla still be considered an ESG investment now that they're investing in Bitcoin, which mostly relies on dirty energy? Not to mention their governance issues. Anyone want to take that?
I feel like that might be one for me, but I am certainly happy for my panelists to weigh in. Tesla is a really interesting company in that landscape because when you look at what it produces in terms of electric vehicles, it could be viewed as scoring very highly. However, if you look at what it takes and the processes, the components involved to create the batteries, it doesn't look quite so positive. And what's interesting is you have a number of companies, MSCI, Sustainalytics are two of the big companies that provide ESG data scores. One of them scores Tesla extremely highly. The other puts it right at the bottom of its rankings, pretty much. So my concern would be less about the recent announcement of the Bitcoin holding, and more in relation to, this is a really big question that investors grapple with, because you have to ascertain where, in terms of how you as an investor assess this company, given the dichotomy within the business.
Especially with the batteries creating more landfills, right?
It's very complex, very complex.
Yeah, I mean, the questioner alluded to Tesla's governance issues, and Tesla probably is the worst governed public company in America at any reasonable size. My favorite stat about that is that for many years, the general counsel was Elon's divorce attorney. And, I'm sure he's a pretty good divorce attorney, given that he's got a lot of practice with all of Elon's divorces. But it's, that doesn't strike me as the general counsel of a, public company with, tens of billions of market cap at the time, and now hundreds of billions of dollars in market cap. So yeah, it's, governance at Tesla is probably going to be a clown show for the foreseeable future, because it has been a clown show for the last 10 years.
And you have Elon tweeting, kind of similar to the prior precedent, where his tweets make an impact on the market, right? He tweeted about a company and everybody went and bought shares in the company, and it turns out that that was not the company he had tweeted about, but the shares of that company went up anyways. So his tweets have a big impact.
Who needs to file an 8K when you can just send tweets?
Exactly. It's affected a lot of different companies based on his tweets over the past month, for sure. Patrick, anything you wanted to add on that?
No, I thought both of you added a lot of value, and my other fellow panelists did an excellent job.
Well, thank you all very much. And thank you to all of you attending for chiming in with questions. I'd like to turn it over to Sarah now with ACG.
Thank you, Sindhu, for moderating, and thank you to all the panelists for participating in today's program. Our next installment of this series will take place on Thursday, April 8th at 10 a.m. Pacific, 12 noon Central, and will focus on SPACs, IPOs, and resulting cultural changes. We hope you will all join us for that.